Do you want to know the secret to building real wealth over time? It's not luck, it's not timing the market, it's long-term investing. And today, I'll show you how it works and how you can start. This approach contrasts with short-term trading, which carries higher risks and increased stress. Consistent, patient investment allows money to grow substantially through compounding. Compounding involves reinvesting earnings to generate additional earnings over time. The power of compounding increases exponentially over longer investment horizons. Compounding growth illustrates the accelerating accumulation of returns on an investment over time. A 200 monthly investment demonstrates the potential of compounding growth. Over 20 years, consistent monthly investments can yield substantial returns through compounding. An average 8% annual return significantly enhances the effects of compounding. The power of compounding can transform modest monthly investments into significant wealth over time. With consistent investment in compounding, a 200 monthly investment can grow to nearly 120 in 20 years. Index funds and ETFs are low-cost investment options. These investment vehicles offer built-in diversification. Index funds and ETFs allow investors to invest in a wide range of companies simultaneously. These funds are suitable for beginner investors. Diversification reduces risk by spreading investments across multiple assets. Index funds and ETFs achieve diversification by encompassing a wide range of companies. A single investment in these funds covers a broad market segment, reducing risk. Diversification minimizes the impact of any single company's performance on the overall portfolio. Index funds and ETFs offer a cost-effective way to gain exposure to multiple assets. Diversified portfolios provide a more stable investment foundation compared to individual stocks. Investing in an S&P 500 ETF provides exposure to 500 of the largest U.S. companies. An S&P 500 ETF offers broad market diversification through a single investment. S&P 500 ETFs mirror the performance of the S&P 500 index, reflecting overall market trends. Investing in an S&P 500 ETF can be a simple way to participate in the growth of the U.S. economy. S&P 500 ETFs provide a cost-effective way to achieve diversified equity exposure. Dollar-cost averaging involves investing a fixed amount of money at regular intervals. This strategy is applied regardless of market conditions. Dollar-cost averaging mitigates the risk of trying to time the market. The goal is to reduce the impact of volatility on the overall investment. Dollar-cost averaging involves making consistent investments at regular intervals, regardless of the asset's price. When prices are low, a fixed investment amount buys more shares of the asset. Conversely, when prices are high, the same investment amount buys fewer shares. This strategy aims to lower the average cost per share over time, reducing the impact of market volatility. Dollar-cost averaging mitigates market volatility by averaging the purchase price over a period. This strategy reduces the impact of market fluctuations on investment portfolios. Dollar-cost averaging involves investing a fixed amount of money at regular intervals, regardless of the asset's price. By purchasing more shares when prices are low and fewer when prices are high, the average cost per share is lowered. Dollar-cost averaging does not guarantee profit or protect against loss in declining markets. Diversification is a key risk management strategy in portfolio construction. Effective diversification involves allocating investments across different asset classes. Asset classes commonly include stocks, bonds, real estate, and cryptocurrencies. Diversification aims to reduce overall portfolio risk by balancing different asset characteristics. Strategic asset allocation is crucial for achieving diversification benefits. A pie chart visually represents a diversified portfolio. Asset allocation across various categories reduces overall risk. Diversification enhances portfolio stability. Different asset classes contribute varying levels of risk and return. Strategic asset allocation aims to optimize returns while managing risk. Patience is a crucial trait for long-term investors. Long-term investors should remain focused on their goals despite market fluctuations. Maintaining a long-term focus helps investors navigate short-term volatility. Market fluctuations are a normal part of the investment process and should not deter long-term strategies. Successful long-term investing requires discipline and the ability to withstand temporary setbacks. Investors should prioritize long-term growth over short-term gains. Historical market data illustrates recovery trends following significant crashes. Long-term investors often experience substantial gains by maintaining their positions through market downturns. Market recovery periods vary in duration and magnitude depending on economic conditions and investor sentiment. Diversification strategies can mitigate risk and improve overall portfolio performance during volatile market periods. Patience and a long-term investment horizon are key factors in achieving positive returns in the stock market. Remaining invested during market downturns increases the likelihood of benefiting from subsequent recoveries. Panic selling during downturns can lead to missed opportunities during the recovery phase. Long-term investment strategies often outperform short-term reactive decisions during market volatility. Market downturns can present opportunities to acquire assets at reduced prices. Emotional decision-making during market fluctuations can negatively impact investment outcomes. Disciplined investment approaches, such as dollar-cost averaging, can mitigate risks associated with market timing. Establishing explicit financial objectives, such as retirement planning, purchasing property, or attaining financial independence, is the foundational step in long-term investment strategies. Clear financial goals provide a tangible roadmap for investment decisions and portfolio construction. Defined objectives facilitate the selection of appropriate investment instruments and risk management strategies. Long-term investing requires a strategic approach, beginning with a clear understanding of desired financial outcomes. Without specific goals, investment decisions lack direction and may lead to suboptimal financial results. For beginners, selecting simple, low-cost investments is a practical approach. Index funds offer diversified exposure to a broad market segment at a low expense ratio. Exchange-traded funds, ETFs, are baskets of securities that trade on exchanges like individual stocks. Low-cost investments minimize expenses, maximizing potential returns over the long term. Simplicity in investment selection reduces complexity and promotes informed decision-making. Index funds and ETFs provide diversification, reducing risk compared to individual stock picking. Dollar-cost averaging involves investing a fixed sum of money at regular intervals, regardless of asset price. Regular investing through dollar-cost averaging is a consistent and effective investment strategy. An action plan with regular investing reinforces a disciplined approach to long-term financial goals. Consistent investing mitigates risk by averaging the purchase price over time. Reinvesting dividends accelerates compounding, enhancing long-term investment returns. Dividend reinvestment involves using dividend payouts to purchase additional shares of the underlying asset. This strategy allows investors to acquire more assets without additional capital outlay. Compounding through dividend reinvestment leads to exponential growth of the investment portfolio. Dividend reinvestment plans, DRIPs, automate the process of reinvesting dividends. Long-term investors often utilize dividend reinvestment to maximize returns and build wealth over time. Annual portfolio reviews are recommended to maintain a long-term investment perspective. Frequent, daily reviews can lead to emotionally driven investment decisions. A long-term perspective helps avoid impulsive reactions to short-term market fluctuations. Emotional decision-making can negatively impact overall portfolio performance. Strategic, planned reviews support rational and consistent investment strategies. Long-term investing is a strategy focused on wealth accumulation over an extended period. This approach emphasizes consistency and discipline rather than seeking immediate, high-risk gains. Time acts as an ally in long-term investing, allowing investments to grow through compounding returns. Patience is a key element, as the benefits of long-term investing typically materialize over years or decades. Long-term investment strategies often involve diversified portfolios to mitigate risk and enhance stability. The power of compounding, combined with consistent contributions, drives significant wealth creation over the long run. Starting long-term investing early can lead to future financial security. Future financial security is a reward for present discipline and patience. Early investment takes advantage of compounding returns over time. Long-term investing requires a commitment to consistent contributions. Assessing one's risk tolerance is crucial before making investment choices. Risk tolerance ensures investments align with the investor's comfort level. Aligning investments with risk tolerance supports the achievement of financial goals. Understanding risk tolerance is a foundational step in financial planning. Thoroughly researching different investment options is essential for making informed decisions. Historical performance data is a key factor to consider when evaluating investment options. Investment fees can significantly impact overall returns and should be carefully assessed. Understanding investment objectives is crucial for aligning investment choices with personal financial goals. Informed investment decisions require considering historical performance, fees, and investment objectives. Periodic portfolio rebalancing helps maintain the desired asset allocation. Rebalancing ensures the portfolio aligns with the investor's risk tolerance. Portfolio rebalancing keeps investments aligned with the investor's financial goals. Rebalancing involves selling assets that have increased in value and buying those that have decreased. Consulting with a qualified financial advisor provides personalized guidance. Professional financial advice is especially beneficial in complex financial situations. Seeking professional advice is valuable for making informed investment decisions. Financial advisors offer support in navigating the complexities of financial planning. Personalized financial guidance helps individuals achieve their unique financial goals. Qualified financial advisors provide tailored strategies to optimize financial outcomes. Continuous learning is essential for maintaining financial literacy. Staying informed about market trends allows for proactive financial decision-making. Understanding diverse investment strategies is key to optimizing financial outcomes. Well-informed decisions are the foundation of sound financial planning. Adapting to evolving market conditions requires ongoing education and analysis. Financial literacy empowers individuals to achieve their long-term financial goals. Start today, and your future self will thank you. Don't forget to like this video, subscribe for more financial tips,